Welcome to ETF Edge, your go-to place for everything exchange-traded funds. It was declared dead a year ago, but now the 60/40 stock bond portfolio is making a comeback. I'm your host, Bob Pisani. With yields on two-year treasuries now approaching 5%, bonds are becoming serious competition for the stock market, and single treasury bond ETFs are seeing big inflows. Let's talk with Alex Morris. He's the president and CIO of FM Investments. Also joining us, Dave Naudick, financial futurist for Verify. Alex, everybody wants to buy two-year treasuries. I was at a party over the weekend at my family's house. My mother asked me about two-year treasury yields. My brother-in-law asked me. Now you know it's really seeping into the zeitgeist. 6 months ago, you launched a series of single bond treasury ETFs, 3 months, 2-year, 10-year treasuries. You've now got a 1-year treasury. Tell us how these work. What do you get when you get, just pick a 2-year treasury bond?
Sure.
What do you get?
So you get just that, the 2-year treasury. And you'll get the on-the-run treasury. And that's an important distinction because every month the Treasury Department issues a new 2-year bond. So eventually, 24 months later, you get your money back. We stay on the run. That's the most liquid of those issuances that happen, and it's the one that you see quoted on TV.
And every on the run simply means that every month there's an auction, a new auction for a 2-year treasury, and you roll over the old one into the new one.
Correct.
Okay. Dave, last year at the ETF conference, I mean in 2022, the 60/40 stock bond portfolio was declared dead by everyone. This year, there was a very lively debate. You were there about whether it was back and to what extent people should roll into bonds again. In addition to my brother, I mentioned my brother-in-law asked me this weekend about putting all his money into treasury bonds this weekend. Something is seeping into the zeitgeist here. When your mother asks you about 2-year treasury bonds, are bonds really becoming serious competition for stocks? And if so, what's this mean for stock market rallies this year?
I think they absolutely are becoming a significant competitor to stocks, frankly, to any risk asset. I mean, you talk about the 2-year, look at the 6-month. Right now, the highest yielding part of the curve is buying 6-month treasury bills. That's nuts, right? That kind of inversion, first of all, is something we haven't seen in a long time, and a lot of folks are concerned about the recessionary impact of that. But that inversion speaks to this belief that we're going to have continued increases in the rack rate by the Fed. That puts us in this position of having to really evaluate the risks of bonds coming down because of increased rates, or looking at what's going on in the stock market, where we're seeing some potential for margin compression. I think there's plenty of concern to be had on the equity side. I've actually talked to a lot of advisors who are a little concerned that the short-term story here may be actually both the principal value of your bonds and your equities coming down, as we saw last year for most of the year. That's a recipe for pain. But on the short end of the curve, you get paid very quickly, right? I mean, if you put in money in a 6-month treasury, you're getting almost a 5.25% yield on that. You're going to collect 2.5% of that in just 6 months. That's incredible.
Yeah, that will ease the pain a lot, Alex, right? I mean, stocks down, bonds down 2 years in a row. That would be a really bad news story. And yet it is ameliorated a bit by the fact that you're getting almost 5% on a 2-year yield. Where does this all lead to? I'm asking a 30,000-foot question here, but what is the right stock bond allocation now? Is the 60/40 dead? Suppose you're 40 years old. People message me all the time. They're 40 years old and I have a moderate risk tolerance. Should I own any bonds? I don't know. The market seems to be voting, saying yes, clearly.
So I don't know the exact right split, whether it's 60/40 or 70/30, but there should be a healthy allocation to bonds. It shouldn't be just treasuries. There should be corporates. There should be a well-diversified basket of it. But for today, it seems that a healthier dose of treasuries makes a lot of sense. Why would you not take a 5% coupon in 6 to 12 months?
Yeah.
It just seems to me, if you were looking to get long-term, say 8% out of that 60 equity percentage, and you can get that today out of a bond portfolio with no risk, seems like it's a good trade to make.
It seems like a no-brainer for a lot of people. You know, Dave, I see very large inflows into short maturity treasury ETFs like Alex's and to others, including the Spider ones and some of the iShare ones. But not as much interest in longer maturity bonds like the 10-year ETF, or even I don't see as big inflows into corporate treasuries. Maybe you do. But why is there so much interest in these very short maturity treasuries right now?
Well, very simply because we know interest rates are going to keep going up, right? I mean, currently the market is pricing in 3 more 25 BIP increases. There's plenty of folks out there thinking that may even be late. We may be even looking at a percentage. You don't want to be in TLT or the 20-year long bond if you know that you've got a 1% interest rate hike coming, because that's going to come right against your duration. And that's what duration means. So it's not surprising at all to see folks really allocating towards the short end of the curve. But the interesting point here is if everybody was doing this, we wouldn't see the rates that are as available as they are. So this is a rare opportunity. I don't think we're going to be looking at an inverted yield curve where you get paid more to own the short end than the long dated end for a significant amount of time. I think that lasts for maybe 6-12 months tops when we get to a terminal rate.
Well, that's a good observation for either one of you. Why are yields this high? I mean, if the demand is really that high, why wouldn't yields be lower, Doug? Or Dave, excuse me. Why wouldn't yields be lower at this point? I don't. You brought up a good point. If the demand is so strong, and my mother's talking about it, why aren't yields lower?
Well, I mean, some of it is really, I think, the long-term asset allocation problem, right? So most folks who are sitting on cash don't think about getting into the 2 years what they're doing with cash. They look at something that is extraordinarily short-term focused. And in fact, you'll see that that part of the curve, the 1 month is actually a little bit lower than, say, the 6 month right now. And that's that hunger for cash. This belly of the curve, sort of from the 6 month to about 5 years, is where there seems to be a real opportunity for real investors to capture some value without taking some of that duration risk of looking at the long bond. It is worth pointing out that the long-term bonds did pull in good assets so far this year, about 15 billion so far, and things dated over 10 years. But that's pulled way back in the last few weeks. We've seen in February. And to your point, everything's about the short term as we're heading into March here.
And I was hoping you can comment on this. I mean, the fact that we're still seeing the interest is in the very shorter term maturities, not in the 10 years, and not even in corporate so much. I'm even seeing outflows from the high yield stuff, like the Spider high yield JNK. There were outflows recently. So this is not some let's go buy bonds across the board. It's a very specific type of inflows, at least in bond ETFs that we're seeing.
Sure. I mean, I think it makes a lot of sense for a bond buyer, particularly first-time bond buyers, who are probably some of the folks we see today, to want to have no credit risk, which is what treasuries offer, and to have the maximum yield they can get. And so everyone is piled in. Plus, the government has been very willing to issue bonds in that category with reasonably high coupons, because that's what the auctions have required them to do. Yeah. Now, I wouldn't abandon long bonds in the long run, right? Once we do hit a terminal rate, there will be some capital appreciation abilities there. And the U.S. 10-year Treasury still remains one of the most liquid securities ever. It is what sets mortgage rates to car loan rates to all of other long-term liabilities. Yeah. So you will see a resurgence in that eventually. But for right now, if you can get a free lunch at 5% in 6 months, investors have voted with their dollars and they're taking it.